$743. That's your COBRA payment. Per month, just to keep the coverage you already have. Not new coverage, not better coverage. The exact same insurance you had when you were employed, with the exact same deductible, and the exact same network, and the exact same copays. Except now you're paying the whole thing yourself. Your share, plus the share your employer used to quietly absorb. And if you have a spouse on the plan, you're not looking at $743. You're looking at $1,486 every month. Before you pay for anything medical, before the deductible, before a single prescription gets filled. You knew this was coming. You ran the numbers before you handed in the notice. You calculated your runway, felt reasonably confident about the decision. And then the COBRA paperwork arrived, and the number was sitting there on the page, and something in your chest did a thing it doesn't usually do. Not panic. Something quieter than panic. The specific, sober feeling of a number that is real and non-negotiable, and going to arrive on the first of every month, regardless of how the rest of your plan is going. This is the part of early retirement nobody shows you in the article with the couple on the beach. The article talks about freedom and flexibility and waking up without an alarm. The article does not talk about $743. Or what happens if you get sick before Medicare starts. Or what happens when the COBRA clock runs out and you're 59 years old, and the marketplace plan costs twice what you expected. Healthcare is the variable that blows up more early retirement plans than any other single thing. More than the market, more than inflation, more than sequence of returns risk. It gets people because they planned everything except this. You are 57 years old. You have $487,000 saved. You left a job that was grinding you down, in a company that stopped valuing the experience you'd spent 25 years building. You made the call. You left. And now you're sitting with the COBRA paperwork and a number you didn't fully price. The gap is the period between the day you stop working and the day Medicare starts. Medicare eligibility begins at 65. If you retire at 63, the gap is 2 years. If you retire at 57, the gap is 8 years. 8 years of paying for private health insurance out of pocket every single month in a market that does not care about your retirement plan. Most people who retire early think about this gap in the abstract. They know it exists. They factor in a line item. They tell themselves they'll figure it out. What they haven't done is price it, month by month, scenario by scenario, at the specific age they're going to be when they need it. That's the work almost no one does before they leave. And that's exactly why the number lands like it does when the paperwork arrives. COBRA keeps you on your employer's plan for up to 18 months. The cost is your full premium, your share plus your employer's former contribution, plus a 2% administrative fee. For a single person in their late 50s on a mid-tier employer plan, that typically runs $600 to $900 per month. For a couple, $1,200 to $1,800. These are not worst-case numbers. Kaiser Family Foundation's 2024 Employer Health Benefits Survey puts the average annual premium for employer-sponsored family coverage at $23,968, nearly $2,000 a month before anyone sees a doctor. COBRA lasts 18 months. After that, it's gone. You're on the marketplace. The first rule. COBRA is not a healthcare plan for early retirement. It's a bridge. 18 months is not 8 years. Price the whole gap, not just the first stretch. The marketplace has features that can work in your favor if you understand how they work. If you don't, you can spend tens of thousands more than you needed to. Here's the piece that matters most. Marketplace subsidies are based on your income, not your assets. You can have $800,000 in a brokerage account and still qualify for significant premium subsidies if your reportable income is low enough. The subsidy cutoff in 2024 is 400% of the federal poverty level, roughly $81,760 for a two-person household. Below that, you get subsidies. Above it, you pay full price. This is not a loophole. It's how the law was written, and it changes the math of early retirement dramatically if you plan around it. There's a layer underneath the basic subsidy structure that most people miss entirely. Silver plans on the marketplace have a feature the other metal tiers don't: cost-sharing reductions. If your income falls between 100 and 250% of the federal poverty level, roughly $20,440 to $51,100 for a two-person household, You qualify for reductions that lower your deductible and out-of-pocket maximum significantly. A silver plan with cost-sharing reductions can outperform a gold plan at a fraction of the cost. The plan type you choose isn't just about monthly premiums, it's about the total financial exposure across the entire year. A retired couple drawing $55,000 a year from after-tax accounts while leaving pre-tax money untouched may pay $200 to $400 a month on a silver marketplace plan after subsidies. The same couple drawing $90,000 a year because they took too much from their IRA too early may pay $1,400 or more for the same plan. At $1,400 a month, that's $16,800 a year in premiums alone. Over 8 years, that's $134,400, just in premiums. Just because the withdrawal sequence wasn't managed, the structure of your withdrawals in the gap years determines whether healthcare costs are manageable or catastrophic. The shift. Healthcare stopped being a line item and became the variable that controlled the entire withdrawal strategy. The question stopped being how much I need to live and became, how do I live within an income band that keeps my premiums down? But this is the optimistic version of the story. The non-optimistic version is where things get genuinely difficult. You are 58, 14 months into retirement. COBRA is 4 months from running out. You've been healthy, a prescription you've been on for years, the annual checkup. Nothing that's tested the plan. And then one morning something is wrong. Wrong enough to get checked. Wrong enough for the doctor to want imaging. Wrong enough for the imaging to lead to a specialist. And the specialist to another specialist. The average deductible for a silver marketplace plan in 2024 is approximately $4,500 for an individual. Out-of-pocket maximums average around $9,450. For a family plan, those numbers roughly double. A serious medical event in the gap, a cardiac episode, a cancer diagnosis, an orthopedic injury requiring surgery, can cost you $9,000 to $18,000 in out-of-pocket costs alone in a single year, on top of the monthly premiums. With no employer, no HR department, no short-term disability, you're navigating all of it yourself. The second rule, the coverage number and the cost of care number are two separate math problems. People price the premium. They don't price what happens when they actually need to use it. This is education, not financial advice. Talk to a qualified professional about your specific situation before making any retirement or healthcare decisions. Now let's talk about what the people who get this right actually do differently. They start planning for the gap while they're still employed. Not the month before they leave, 3 to 5 years before. They name the gap, they price a marketplace plan in the county where they're going to retire, and they model their income structure in the gap years to identify the withdrawal strategy that keeps them below the subsidy threshold. Then they build a healthcare reserve, a dedicated bucket of money whose only job is covering premiums and out-of-pocket costs from COBRA day one to Medicare day one. The geography piece matters more than most people expect. Marketplace plan quality and network coverage vary enormously by county. In some markets, there are 3 or 4 strong insurers competing for your business, solid networks, reasonable access to specialists. In other markets, particularly rural areas and smaller metros, there may be one insurer offering one plan with a narrow network and a high deductible. If you're planning to retire somewhere other than where you currently live, you need to research the specific marketplace options in that county before you commit to the location. Not after, before. The plan available to you is determined by your zip code, not your preference. The healthcare reserve calculation isn't complicated, but it has to be honest. Take the number of gap years, multiply by 12, multiply by estimated monthly net premiums, add an annual out-of-pocket buffer. For an 8-year gap at a subsidized $350 monthly premium and $3,000 annual out-of-pocket buffer, that's roughly $57,600 in dedicated healthcare funds. Before food, before housing, before travel. Most people don't have that number sitting separately. They have it mixed into the general budget, and they're assuming it gets absorbed. That assumption is where the gap catches people. The shift. The healthcare gap is not a line item in the retirement budget. It's a separate financial problem that needs its own dedicated solution before the rest of the budget gets built. The HSA is the most powerful tool for funding it. A health savings account, available only with a high deductible health plan, lets you contribute pre-tax dollars and invest them. Withdrawals for qualified medical expenses are completely tax-free. After 65, you can withdraw for any purpose, and it functions like a traditional IRA. The 2024 contribution limits are $4,150 for individuals and $8,300 for families. The money goes in pre-tax, grows tax-free, comes out tax-free for medical costs. There is no better vehicle for funding the gap. The third rule. The HSA is the most tax-efficient tool available for healthcare gap funding. If you're not maxing it while you're still employed, you're leaving money in the government's pocket that belongs in yours. If you're watching this and that number sounds like your number, drop it in the comment. You'll see you're not alone. Now let's talk about Medicare itself, the destination at the end of the gap. People treat it as a finish line, the moment when healthcare becomes simple. It is not a finish line. It's a new set of decisions with its own costs and its own enrollment traps. Medicare Part A covers hospital care and is premium-free for most people. Part B covers outpatient care. The standard 2024 premium is $174.70 per month. Part D covers prescriptions. Traditional Medicare does not cover dental, vision, or hearing. For that coverage, you either add a Medicare Advantage plan or purchase supplemental Medigap insurance, both of which carry their own premiums, their own network restrictions, and their own trade-offs that deserve at least as much research as the gap coverage did. There's also the IRMAA issue that catches higher-income retirees off guard. IRMAA, the Income-Related Monthly Adjustment Amount, is a Medicare surcharge that kicks in when your income in the prior 2 years exceeded certain thresholds. In 2024, a single person with income above $103,000 pays an additional $69.90 per month on top of the standard Part B premium. A couple above $206,000 pays the same surcharge per person. It's based on your tax return from 2 years prior, which means a year of high income during the gap can follow you into Medicare and increase your premiums after you've already arrived. The enrollment timing matters. If you miss your initial enrollment window, which opens 3 months before your 65th birthday and closes 3 months after, you face permanent premium penalties. For every 12-month period you were eligible but not enrolled, your Part B premium increases by 10% permanently. 2 years late is a 20% penalty you carry for the rest of your life. The rules are specific, and the Social Security Administration is not going to remind you when your window opens. The fourth rule. Medicare enrollment timing has permanent financial consequences. Build your 65th birthday into your planning calendar years in advance and treat enrollment as a deadline, not a suggestion. Let's come back to where you are now. 57 years old, $487,000 in savings. The COBRA paperwork on the kitchen table. The $743 sitting there on the page. Here's what that number tells you if you're willing to read it correctly. It tells you the gap is real and it has a specific cost. 8 years at an average of $600 a month in net premiums after subsidies, plus $2,500 a year in out-of-pocket costs. That's roughly $86,000 over the gap. Built into your plan or not, that money is going somewhere. The only question is whether it comes from a dedicated reserve or out of the retirement income you were planning to live on. It tells you the income architecture you build in the next few years matters more than the return on any single investment. Getting your income low enough to qualify for cost-sharing reductions on a silver plan could save you more in a single year than a percentage point of investment return on your entire portfolio. It tells you that the gap is manageable, but only if you manage it. The people who walk in with a vague line item and good intentions are the ones who draw from savings faster than planned, or go back to work they didn't want to do, or go without coverage and hope nothing happens. None of those outcomes are inevitable. All of them are the result of pricing the dream and not the details. The shift. $743 stopped being a number on a piece of paper and became information. The question stopped being, can I afford this, and became what the whole picture actually costs, and how do I build a plan that accounts for every year of it? The fifth rule. You cannot build a healthcare plan from inside the gap. By the time the COBRA paperwork arrives, the structural decisions, retirement timing, income architecture, HSA funding, have already been made or missed. The gap plan is built years before the gap begins. You close the paperwork. Not because the number got smaller, it didn't. $743 is still $743. You close it because you understand what it's telling you now. It's telling you the gap has a cost, and the cost is specific, and you have time to do something about it. You'd rather know that now than discover it when the options are smaller. Somewhere tonight there is 53-year-old running retirement projections on a laptop, working through the savings math and the income math and the Social Security timing. They haven't opened the healthcare tab yet. It's right there in the browser. They know they need to look at it. They keep meaning to get to it. They think this story is about what early retirement costs. It is. It is also about the specific cost that most people don't price until they're already inside the gap, when the decisions have already been made. Open the tab. Run the numbers. Not the coverage number, the full number. The gap is real. The math is doable. But only if you do the math.